Good morning, everyone. I'm sorry we broke our streak of having no technical problems up until this morning. Hopefully you can all hear me now and we can start the webinar with no issues. Bevan, my colleague, is monitoring the Q&A and the chat box, so if you have any issues, please type them in and he can answer that for you. So, welcome to this last webinar in our Small Business series. If you've missed any of the first three webinars, they will be available on the blog section of our website. We've already got the first two there and the last two will be up by this afternoon. We'll also send you out this information and the links in an email this afternoon. So the plan is to keep the presentation to within 45 minutes. As I said, Bevan's monitoring the chat box and question and answers, so please feel free to ask any questions and he will answer as we go along. If at the end we've got any time left, we'll answer as many questions as we can. So who are we? We're an accounting firm located on the very beautiful but slightly chilly Sunshine Coast in Queensland. We are a small firm and we specialise in looking after small businesses. We don't really have a typical kind of client, and I think we'd probably have a client in almost every industry I could think of. And these clients vary in size from, small startups to some of our clients have numerous businesses in numerous structures. Many of our business clients are on a fixed monthly fee, and the benefit of this is that it takes away that barrier of you picking up the phone to give us a call and have a chat about things. Because you know that that's all included in that fixed monthly fee and you're not going to be getting an unexpected bill in the mail. We are most definitely in the middle of tax planning season at the moment, and this is also a service that we do offer to our clients when we tailor make a fixed fee for them. On a personal level, I knew from the moment I did business principles in year 8 of high school that this is what I wanted to do with my life, as sad as that may be. And this year will be my 20th year as an accountant in this field. So if we're able to help you or you want to have a chat about anything in today's webinar, please don't hesitate to contact us. So the objective for today is to let you know some of the tips and tools to help minimise your tax. And please note that I said minimise your tax. There's nothing wrong with using these strategies to minimise the level of tax you pay. Tax avoidance through elaborate scams is, of course, completely illegal. So legally, we have to let you know that this is general information as it has not been tailored specifically to your situation. We strongly suggest you discuss any strategies with your accountant to make sure they are suitable for your situation and business structure. So let's kick off the webinar with a brief introduction to how tax works on various entities. Firstly, let's have a look at a company structure, which is probably the simplest from a tax calculation point of view. A company has a flat rate of tax of 27.5%. A flat rate means that the company pays tax, 27.5% tax on each and every dollar of profit. Pretty easy. Individuals, however, are a little more complicated. So if you're a sole trader, then tax is payable on your total taxable income, which is the net of income and expenses from all sources. So your business profit is added to other income in your name, for example, rental income or interest income. And then you take off all tax deductions like donations, rental expenses. This taxable income is then taxed using these marginal rates that we show on screen. So for example, if you earn $37,000, you pay no tax on that first 0 to 18,000, and then you pay 19 cents for each dollar. So basically at 37,000, you'd be paying $3,572 in tax. You'll notice this table says that you pay no tax on this first 18,200. It's slightly misleading because with the tax offsets we have, you can actually earn about $20,000 before you pay any tax. So basically, if your business profit and other income is less than $20,000 and you're a sole trader, there is no need to do any tax planning as you really can't save any more tax than paying nil. I also want to quickly cover partnerships. If you have a partnership of two individuals, the profit gets split in line with your partnership agreement or partnership percentage, which remains unchanged each year. The individual then includes the partnership income in their return and it forms part of their taxable income. Let's have a look at a trust structure because it works very differently. Trusts do not pay tax in their own right. Instead, in the tax return of a trust, it must nominate who is to receive the profit. These people or companies are called beneficiaries. They then declare the income in their tax returns and they're the ones who pay tax on it. The benefit of operating your business from a family or discretionary trust is that every year the trust has the option of deciding who is going to receive the profit and what portion of that profit they will receive. So looking at an example, if the trust made a profit of $100,000 in year one, it can decide to give Jenny $75,000 and her adult son Bill $25,000. However, the next year, Jenny might be earning a lot of income from another source. And so that year, with a profit of $80,000, we can choose not to give Jenny any of that profit and give Bill the full $80,000. If you want more information on the typical savings using a trust, have a look at the examples on our website on the blog page. I'm going to get Bevan to put a link in the chat box. And also, if you haven't already, have a listen to the webinar Bevan did on business structures. Trading in this kind of structure can obviously result in large tax savings, and this is why trusts constantly come up on every government's hit list to find a way to stop these tax benefits. It gets threatened every single year that they're going to do something about trusts, and it hasn't happened yet, and personally I think there's going to be some pretty serious legal hurdles that they'll have to get over to make this kind of legislation stick, but never say never. So now that you're all over how the tax gets calculated, let's have a look how the deductions work. So let's assume that a business has a profit of $100,000. A company will pay $27,500 on that profit, and an individual will pay $26,632. Then, after watching this webinar, they decide on a strategy that's going to give them a tax deduction of $10,000. A company will, of course, save $2,750 because of the tax rate is 27.5%. Or another way to think of this is for every dollar spent, the company will save 27.5 cents. With individuals, however, it's really going to depend on what their taxable income is due to those marginal rates. So assuming the same $100,000 in profit with an extra $10,000 deduction, it will save them about $4,035, which at 40 cents in the dollar is good. The reason this is really important to understand is I often hear clients have worked out that they've got about $30,000 or $20,000 tax to pay. And so they go out and they spend $20,000 on a piece of equipment. Then they go and get their tax prepared by us, and they're really annoyed that that $20,000 that they spent didn't wipe out their $20,000 tax bill. So I hope that kind of gives you so if you're in a company and you've spent $20,000, then, you're only going to save 27.5% on that. So this also leads me into a brief discussion on losses. The ATO, of course, have restrictions on how you can treat a loss in your business. If you're a sole trader, these provisions are called non-commercial losses. And it means that if your business makes a loss for the year, in order to offset that loss against other income like wages, the business will need to pass one of the following tests. So these are the 4 tests. The business either has to have made a profit in 3 out of the last 5 years. It has to have sales of $20,000. It must use land in the business worth more than $500,000, or it must use assets worth over $100,000. And this includes plant and equipment and stock, but it specifically excludes vehicles. Please note there is an exception for these rules if you're in the business of primary production or professional arts. Now, if you are operating through a trust, it works differently. Trust losses do not get distributed to any beneficiary, and rather they get kept in that trust, and they will carry forward every single year until that business finally makes a profit, and then it can offset the loss. I really can't stress enough that the starting point with tax planning is to be able to calculate what your profit is going to be for the year and what tax will be paid on that profit. In calculating the tax payable, there is also currently a small business tax offset which can reduce the tax bill for an individual up to $1,000. This will apply to you if you're a sole trader or you have income from a trust or partnership. It does not apply to companies. I've included the formula from the ATO website, but as you can see, it's all very variable based on what was your business income, what was your total taxable income, and what was your tax liability on that. So once you know your profit and total taxable income, you can go to the ATO website and use the calculator that will tell you exactly how much of a tax offset you will receive. Now that we know who the government is, I'm starting to get some questions from clients about the $1,080 tax refund that was announced in the budget, and if there's anything they need to do to get that. At this stage, the full amount won't get introduced into Parliament until late June, and so at this stage, there's pretty much no chance it's going to be legislated by tax time. However, the ATO have announced that if the legislation is passed after you've lodged your tax return, they will automatically amend it and send you the difference. However, the thing about tax offsets is that they only reduce the amount of tax that you have to pay. They can't form a refund. So, for example, the $1,080 per individual will apply if you earn between $48,000 and $90,000 is the maximum amount that your tax can be reduced by. If you have an income up to $48,000 or between $90,000 and $126,000, you won't get the full amount of $1,080. Obviously, all these calculations can get a bit complicated, and please do ask your accountant for help if you need. Now, the last other tax planning consideration is to employ your children. So whilst there is generally an age restriction imposed by Fair Work, this does not apply for family arrangements. So as long as the work they do is reasonable for their age and you can justify it, they can be paid. The good thing about paying your children is, as long as they're under 18, you don't have to pay any super contributions for them. And if they don't earn any more than around $20,000, you also won't need to pay any pay-as-you-go withholding, because as we saw before, you can earn up to $20,000 before having to pay any tax on it. Now, not all tax planning strategies include outlaying sums of money. Some of the strategies I'm about to cover mostly just involve cleaning up your financials. The first strategy is stock adjustments. If you are a business that carries stock, then it's time to look at its value. I explained why we account for stock in our webinar about understanding business financials, so I'm not going to go into detail about that again. But in brief, stock has an opening value, then you have purchases for the year. Now these amounts together reduce your amount of profit, but then once you add closing stock in, it increases the amount of profit. This is why you really want to make sure you are reporting the stock at the correct amount and not a higher amount, which would increase your profit. The closing stock for any given year then rolls over and becomes the opening stock for the next year or the next period you're working in. Now, stock figures are usually calculated on the price you paid for that item of stock, which is called the cost price method, but there are other methods you can use. Market value is the price that the product could be sold for, and there is also replacement value, which is pretty self-explanatory. So let's say you're in a toy business, and a couple of years ago you bought 1,000 fidget spinners at $1 each because the kids would buy them at $2 as quickly as you could put them on the shelf. But this particular shipment of spinners had some logistic issues, and by the time it arrived, the next big fad in toys had taken over. So you now have this stock in your financials that's worth $1,000, but to be honest, you can probably only sell them for 50 cents. So by adjusting your closing stock figure to the market value, you've reduced your closing stock and profit, therefore, down by $500. Now, with tax planning, it's not really a big numbers game, it's how many little things can we do to get a really good result. The really good thing about valuing stock is that you can choose which method for each product. So while you might want to use the market value for the obsolete spinners, another method may give you a better result for your other products. This strategy also works the same for service industries that record work in progress or WIP. Our next no money strategy is looking at invoices you have issued that your customer or clients have not yet paid and writing off any that you are not likely to ever receive. Now, this method only works if the income you report to the ATO include amounts that debtors owe you. This is called the accruals method, and we covered this in the Understanding Financials webinar. If you do use the accruals method, then adjusting for bad debts will reduce your profit. If, however, you're on a cash basis and report the actual money received into your bank, then you have the option of holding off issuing some of your June invoices until after July. Now, this strategy doesn't make it onto my favourites list, but if you had an absolute bumper of a year and just can't face paying any more tax, you may want to consider it. Our final no money needed strategy is a simple claim everything you are entitled to. This can be as simple as working out a system to make sure you actually keep your receipts so you can claim them. Or it might be considering whether you should claim your motor vehicle expense via a logbook method or cents per kilometre method. The logbook method requires you to, funnily enough, keep a logbook for 12 weeks, recording all travel, both business and personal, to work out the percentage the car is used for business purchases. This logbook only has to be completed once every 5 years, and it will always give you a better deduction if you use your car frequently in your business. Now that you know the percentage, you also have to keep track of all expenses throughout the year that relate to your car, which include fuel, rego, repairs, and insurance. The alternative is to use the cents per kilometre method, which involves recording the kilometres travelled for business use throughout the year and claiming the rate set by the ATO, which has finally gone up this year and is now at 68 cents per kilometre. Also ensure you're claiming any home office expenses you're entitled to. The ATO allows you to claim 45 cents per hour for each hour you work in your home office, but you do need to keep a diary for 4 weeks to show your usage. This 45 cents is meant to cover electricity, cleaning, and the depreciation on office furniture. However, if your home office is a dedicated space in your home that isn't or can't be used for anything else, you may also be able to claim occupancy expenses. If you rent your home, then you should definitely be claiming a percentage of your rent and insurance. Now, if you own your own home, you can also claim occupancy expenses such as interest, insurance, rates, and water. But we don't normally recommend this because when you sell your home, you won't get that percentage of your sale capital gains tax free. Now, the rules around claiming home office expenses are quite restrictive, but keep in mind that using your garage for storage is not the same as a home office, and neither is parking your business car in your garage. So now let's move on to the spending strategies. Now, straight up, I'm going to say I am not a fan of spending money just for the sake of reducing the tax bill. As we saw earlier in the webinar, if you're in a company structure, for every dollar that you spend on tax deductible items, you're only going to save 27.5 cents. So spending money on items for the sole purpose of reducing your tax just does not make financial sense. However, what does make sense is looking at what the business needs and what you are going to purchase in the future anyway, and moving that expenditure into the current financial year. So, for example, if you've got a computer that's a few years old and you know it's going to be replaced in the next few months, and you also know you're going to have a tax bill that brings a tear to your eye, then it makes absolute sense to buy that computer now instead of waiting until after the 30th of June. You can currently spend up to $30,000 or $33,000 if you're GST registered and get the full amount as a tax deduction. The limit of $30,000 came in on budget night on the 2nd of April and stays in effect until June 2020. If you've already purchased equipment through the year and want to know how it's going to get treated, I've listed the amounts as we've had 3 different changes throughout this financial year of what the limits were. Now, it's important to note that the $30,000 limit is per item, not per year, but it does have to include everything in getting that item or asset ready for use. So let's, for example, say you buy a $25,000 ute, but then you go out and you purchase new tyres, a bull bar, towing winch, canopy and a stereo, which altogether costs $7,500. Those two amounts together mean you have gone over that $30,000 limit. If, however, you purchase the ute this financial year and all the other items a few months later, they would be considered a separate asset. The $30,000 limit also looks at the purchase of similar assets. So if you, for example, have a large multi-building premise that all have its own air conditioning system, and one of these systems costs $2,500, then you can claim it immediately. But if you went out and purchased 13 of these, then they group them together and, that has gone over the $30,000 limit. If you're going to buy equipment or a motor vehicle that costs more than $30,000 and you need to finance it, then the type of finance you apply for can have a big impact on your profit and hence tax for the year. If you get a lease, it's really simple. You just claim the full lease payments each month as a tax deduction. However, the ATO considers that any other type of finance mean that you own that asset immediately, which means you can claim depreciation on that asset. Each year, the ATO publish a list of assets and their lifespan, but as a small business, you can use a simplified method called a general pool. The rules for a general pool are that in the first year, you can claim 15% depreciation on that asset, and every year after, you claim 30%. So let's look at an example. So you're going to go out and you're going to purchase a $60,000 motor vehicle, and the payments are going to be $725 per month. So if this was a lease, then the only thing you'd get to claim in this financial year is the $725 payment that you might make in June. However, if this is a hire purchase, then you get to claim the depreciation on that motor vehicle. So $60,000 at 15% gives you a $9,000 claim for depreciation, and there'll also be a bit of interest on that $725 payment. So you can see that it's quite a substantial deduction compared to having a lease. Now, over the life of these finance, it's going to work out the same, but it makes sense that if you're having a year where you're going to have a tax problem, you can look at the kind of finance and say, well, I want to get that bigger deduction now, and we'll see how the cards fall in a few more years when I'm getting probably a lesser deduction. Another thing to note about the general pools is if you already have a general pool from previous years and the balance is below $30,000 on the 30th of June, then you can write off the entire amount as a tax deduction. Finally, I just wanted to mention there are some advanced options about using your own company as the financer of the deposit that also provide asset protection. But as always, you should talk to your accountant before applying new finance to discuss any kinds of strategies they can employ. What are some other spending strategies? Well, you can look at prepaying some of your expenses, and this can be anything like rent, rates, advertising, telephone, internet. However, if there's a private use percentage of this, please be aware you won't get the full benefit. Now, the limit of what you can prepay is up to your imagination, but obviously it has to relate to the business, and you can't prepay more than 12 months worth Otherwise, you won't be able to claim it. Income protection insurance is another expense that's fully tax deductible, and it will certainly give you peace of mind knowing if you are sick or injured, that money will still come in to meet your financial commitments. And then finally, let's talk about super. So, being honest, business owners and super don't normally go hand in hand, but I'm sad to say I've been an accountant for long enough now to see some of my older business clients who really have no prospect of retiring. They also never believed in super, as they thought that they would just eventually sell their business. But some of them found themselves in a redundant industry, think your photo shops or video stores, or some of them are in a service industry with a large client base that is very, very loyal to them. Now, the problem with these kinds of businesses is that when you have a very loyal client base and you leave the business, then they tend to start looking elsewhere and seeing what other prices are available. So I will say, seriously, consider putting money into super. Now, there's two types of super contributions. There's a non-concessional contribution, which nobody claims a tax deduction for, and I won't cover this today, and concessional contributions, which as a business owner, or even if you haven't started your business yet, you can still make super contributions for yourself as an individual and claim a tax deduction. The yearly limit on concessional contributions is $25,000 from all sources. So this will include things like any payments your employer's made for you, any salary sacrifice amounts you've made, and also any contributions you claim a tax deduction in your business for. So you can't go over that $25,000 limit for the year. This used to change, the rate used to change based on your age, but now it is just a collective $25,000. Now, certainly you don't have to put in that full amount, but it is worth starting to contribute something, even if it's just a small weekly amount that's set up via a direct debit. If you have 10 years to go to retirement, then $1,000 invested with a 7% return that compounds monthly will double and become $20,000 after that 10 years. The more you can contribute and the sooner you can contribute really enables your money to start working better for you. If you're on the other end of the scale and approaching retirement, I really do urge you to talk to your accountant or financial planner about some superannuation strategies that increase your business deductions, but really will also help you to boost your super balances. Well, we've come to the end very quickly of today's webinar, and I really appreciate you taking time out of what I'm sure will be a very busy schedule for you. If you haven't already watched the last 3 webinars we presented this week, which were business structures, understanding financial statements, and planning and budgeting, please go to our website and you'll find them on our blog page. I really do believe that if you watch all 4 of these webinars, you're going to have more knowledge than the vast majority of small business owners in Australia. As always, we're really happy to help you, and please don't hesitate to contact us if we can help. Now, I'm going to turn the recording off now, and we're going to answer some questions via the Q&A.